that toy, that new week opening gap, that's just a small cog in the great machine that is my algorithm. It's one little piece that when it's there, it's useful. But we're away from that new week opening gap. Remember that? The new week opening gap for this week is way above us. When I was teaching you, when I first introduced it 2 weeks ago, I said that that new week opening gap is a magnet for price action, and it will use that reference point in price for constant referral to fair value. It's a fair value range that continuously will be referred back to as long as we're in consolidation. But in instances where we move away from that new week opening gap, and again, for those that are new, you're wondering what that is, the new week opening gap is the closing price on Friday, and then the opening price on Sunday. When the markets open up, whether it be Forex, whether it be stock index futures, whatever, it works on stocks too individually. So I have a lot of folks that are interested in stocks. They like trading the SPY. They like trading the triple Qs. Okay, it works there too. These signatures are algorithmic. It has nothing to do with anything retail. They're very specific ranges, and they're very specific levels. The highest high of the gap, the lowest low of the gap. The midpoint, which is consequent encroachment. Consequent encroachment is always the mid-range or middle point of an imbalance or inefficiency gap. A wick, algorithms see wicks on candles, that is a gap to it. So it's going to split it in half, and that's consequent encroachment. I've taught you that as well in the last 2 weeks. These factors will help you trust the market profile that you're in. Now, let's go back and refer to how I opened this live session up this morning. I stated that we were coming on the heels, of a holiday that was yesterday. So we had abbreviated trading session hours yesterday, 9:30 to noon, and then trading stopped. I don't like trading on holidays because you're already demanding a lot of delivery and price inside of a small little range of time. It could do it, but I got better things to do instead of sitting in front of a chart and try to demand a move inside of 2.5 hours. Could I? Yes. Should you? No. Can you go back and study it? Yeah. Is it beneficial? Sure it is. But because we're opening up on the heels of a holiday, we had truncated trading hours, not the full trading session hours. It's like coming off of the Christmas break. You got to let the market fall back in to its normalcy, because there isn't a rush for people. Only retail traders, the small-handed street money traders, are rushing to get back in here the very first minute that the market opens up after a holiday. They can't stand it. It's like they've been kept from the casino too long, and they can't wait to go in there and pull the one-armed bandit little slot machines, because they have to have an experience. You don't want to have experiences in trading. You want to be speculating with probability in your favor. So if we didn't have the holiday factor that we mentioned this morning, and you should have in your notes, anytime we have a holiday, that's going to be impactful to trading on the very next morning session. It's going to make it difficult. It's going to be fickle. Okay, the market's going to be more prone to do what? Create seek and destroy conditions. We didn't get it this morning, but it very well could have happened. Because we're so far away from the new week opening gap, and we failed to run higher after taking that buy side here on ES. Once we broke down like that and we moved into this fair value gap here, then we're in a trending model. Trending where? Lower. Why? Because we're so far away from the new week opening gap. It's not interested to go back up into the Friday closing price and the opening price on Sunday. It's not interested to revisit that. So there's a factor of weighing out market profiles, conditions, not market profile, like some of you trade with the approach of, it's not the same. And I know I'm not looking at market profile like you might be thinking. I'm saying like templates, okay? A schematic, a roadmap, a way of expecting price to deliver a very generic procedure or process. If it's going to be trending, if it's going to be in a condition of market trending, not just consolidation and choppy range-bound consolidation. Range-bound consolidations are expected and confirmed when price continuously stays real close and returns back too frequently the new week opening gap. If the market can stage a run away from that new week opening gap, and we're not on the heels of holiday setting, expect trending. How do you know when it's going to be a trending model and when it's going to be consolidation? I just taught you. Again, I taught this when I first introduced the new week opening gap. If we're going to be in range-bound conditions, it's important to know what tools they refer to. That way it helps you. It keeps you founded on sound logic and not chasing every minor little fluctuation in price action. There's rules, there's processes, there's things that we have to use for filtering. And you thought it was just simply go in here and look for an order block or a fair value gap and you're going to be rich. No. There's no 5-minute learn ICT trainer that's going to give you consistency. They might introduce a concept in a very abbreviated fashion for clicks and views on their YouTube channel, but they're not going to dig into what's needed for you to be successful with what I've adopted, created, and authored. You can't shortcut this stuff. There's a right way of doing it.